Welcome back everyone. So today let's continue from our major topic in the last video, which is some basic economics. I know that this might not be very interesting to you, but understanding economics, macroeconomics in this case, is going to be really important for any investor. So before we start, I need to make it clear that everything we will talk about is extremely simplified and only a framework to describe things in real life. For one very glaring example, simplified economics states that all participants are very rational, perfectly rational, which is obviously not true in real life. And that's just an example to show you how things are very simplified here, and they should only be used as a broad guideline to explain things in real life. So first, let's talk about GDP, which stands for Gross Domestic Product. So GDP measures the market value of all final goods and services produced within a nation's economy, which just means that you're not double counting goods, so you're not counting intermediate goods between, manufacturing and sort of added production. Now, GDP is calculated by adding personal consumption, or rather consumer spending, with government spending, net exports, which is just the exports of a nation minus the imports, and business investment. As a note, business investment is very different from the investments we're going to talk about later on. So business investment refers to the cost of acquiring capital goods, so things like developing real estate, building factories, and acquiring inventory. Now, if you graph the aggregate demand and short-run aggregate supply curves of a nation's economy, you're going to find that the equilibrium point, the x-coordinate, is going to equate to the GDP, and we also call GDP output because it measures the output of an economy, and the y-coordinate will be the overall price level of goods and services. Now, you've probably also noticed a line called long-run aggregate supply. Now, the idea behind a long-run aggregate supply is that in the short run, aggregate supply curve, price level can't be readjusted, but in the long run, both price level and output are fully flexible, and thus they're not related because they can be independently adjusted. So because of this, long-term aggregate supply is really only impacted by the resources and technology available in an economy. So long-run aggregate supply curve is also going to be the location where a nation's natural rate of unemployment exists. And as an aside, unemployment rate is measuring the amount of people seeking jobs whilst not employed. So the formula is going to be people seeking jobs not employed divided over people working plus people seeking jobs not employed. So to better understand our next concept, we're going to have to first show the idea of a production possibilities curve. So a production possibility curve, or PPC, shows the trade-off between production of different items in terms of opportunity cost for another item. Meaning, if you can only produce two sorts of items, what's the cost in producing one sort of item in terms of lost production of the other item? So from a macroeconomic point of view, this trade-off occurs between consumption and capital goods, the latter, as we discussed, known as investment. So the PPC's frontier shows the maximum capability of a nation's current production. As such, you can think of the current long-run aggregate supply curves as one of the infinite selections located on the production possibilities curve. So we're going to be now talking about the business cycle. So the business cycle describes the fluctuation of a nation's economy, including periods of expansion and contraction. So this fluctuation can be visualized with the aggregate supply curve and the short-run aggregate demand curve and short-run aggregate supply curve. And these two are going to be constantly moving while long-run aggregate supply, or maximum potential with full employment, remains relatively static. Now, in this chart, you're going to be seeing that GDP is exceeding what should be possible, the maximum potential. So you might be asking how that's possible. So in this case, the economy is overheating, meaning it's growing at an unsustainable rate. It's going to bound to come back down because workers are getting overworked, inflation is going to be getting too high. So even though real GDP exceeds the potential, it's really unsustainable. So these fluctuations tend to happen in a cycle, so thus why we call it the business cycle. So choosing, let's say, the expansion phase as our starting point, the economy is going to peak. Eventually, it's going to go through a recession as production falls. Eventually, the economy will reach a trough and start expanding again. Now, keep in mind that despite this drawing, the cycle is hardly periodic or predictable. The expansion phase might last for like 5-10 years. It's different every time. And that's the thing about it, right? These concepts make things look really simplified, even though they're not really, so keep that in mind. And you can sort of see the business cycle being broadly mirrored in the stock market as well. So I pulled up a graph of the S&P 500 during the Great Recession. So as you can see, there's sort of an expansion in the stock market. They call it a bull market when the market's up. And then it reaches a peak, and then eventually it falls through in a recession. It falls, so we call it a bear market, and it reaches a trough and starts going up again. So while we're on the topic, we can also talk about the correlation between growth, inflation, and unemployment. So inflation is just a measure of the increase in the general price level. So high inflation means the price level rises at a rapid rate. Lower inflation just means that the price level rises at a lower rate, and deflation means the price level is decreasing. Generally, during expansion, inflation increases while unemployment decreases, mostly because, well, demand increases during expansion. And because of that, in recessions where demand becomes lower, you're going to see that inflation decreases while unemployment increases, right? Because when you're expanding, unemployment's going to be lowering. When you're in a recession, unemployment's going to get higher. So you can see that these are negatively correlated. And we can see that inverse correlation through a Phillips curve, which just means that we're going to be plotting unemployment on one axis and inflation on the other, and you can see in general how they're inversely correlated. Now, I say general because there is one particular situation in which both inflation and unemployment both rise, and that's, you probably heard of this term, it's called stagflation. Now, stagflation is mostly caused by negative supply shocks. So supply decreases, and this causes the price level to rise and output to fall. And because of this sort of double whammy of both inflation and unemployment being high, it's probably one of the more dreaded unemployment and inflation situations because, well, you get the worst of both worlds. And the last thing I want to talk about in this video is going to be inflation. So inflation refers to the general price level, or more specifically, the rise of the price level. So I'd imagine you probably know the problem with high inflation. If you're in the US, we had a case of relatively high inflation in 2022, where we saw gas prices, things like that, rise a lot, which put a lot of strain for consumers. So, of course, generally, right, inflation causes a lot of pain for consumers because, well, the purchasing value of their money goes down, right? The currency becomes devalued. Now, the opposite of inflation is deflation, which is when prices decrease. Now, at first glance, this might sound pretty nice, right? Who wouldn't want their dollar or whatever currency you use to become more valuable, right? As prices go down, whatever. But oftentimes, deflation can be really dangerous to an economy. Since if you think about it, if consumers and companies and everyone realizes that a unit of currency tomorrow is going to be worth more than today, or, 5 years down the line, a dollar is going to be worth more than today, then why would you spend anything that's unnecessary, right? So this decrease in spending across the board is going to cause, well, businesses to shut down, and they're going to have to lay off people to cut costs, right? Because there's no more sort of extravagant or a lot of spending in an economy. And well, if businesses start laying off or shutting down, then people are going to be willing to spend even less, right? Because if you're jobless, well, you don't want to spend a lot of money. So then, of course, the cycle repeats as an economy stumbles into a pretty big spiral of deflation and a recession. So because of this, nations normally aim for a low rate of inflation. So central banks across the world sort of deem 2% as sort of the ideal inflation rate. Mostly because, well, you're not devaluing the currency too much, but you're also not heading into deflation. And the idea behind 2% is that it's a figure that's not going to be really painful for consumers, but it's going to sort of stimulate spending and investment. So that's all I have for today. Thank you for watching, and I'll see you next time.